Imagine preparing your entire life for the last war, building defenses against yesterday's enemy, training for yesterday's battlefield, studying yesterday's mistakes. Then one day, the next conflict arrives, completely different. History repeats, but systems evolve. And evolving systems rarely fail in identical ways. This is one of the greatest mistakes people make when thinking about recessions. They expect another 2008, another housing collapse, another banking panic, another credit freeze. But financial systems learn, regulators learn, banks learn, investors learn. The architecture changes, which means the next crisis is unlikely to emerge from the exact same place. Because every major crisis strengthens one part of the system, while quietly shifting vulnerability somewhere else. The question is no longer, when will another 2008 happen? The better question is, what system has become today's weakest link? Today, we decode why the next global recession will almost certainly be different from the last one.
Every financial crisis begins with an architecture, not an event, an architecture. In 2008, that architecture centered around housing. Mortgage lending expanded rapidly. Financial institutions packaged those mortgages into securities. Risk appeared diversified. Credit became abundant. Leverage multiplied. The system functioned beautifully as long as housing prices continued rising. But systems built upon a single assumption become fragile. Once housing prices weakened, the architecture reversed. Collateral declined, confidence disappeared, liquidity evaporated. Banks stopped trusting one another. Credit froze. Notice the sequence. The crisis did not begin when markets crashed. Markets crashed because the underlying architecture had already failed. The visible collapse simply revealed the invisible weakness that had been growing for years.
After every major failure, systems adopt. Bridges are redesigned, aircraft are improved, financial systems evolve. Following the global financial crisis, banks increased capital buffers. Stress testing became more rigorous. Regulations expanded. The architecture learned. This is an important principle. Systems rarely repeat identical mistakes. Instead, they develop new trade-offs. Strength in one area often creates complexity somewhere else. Capital shifted. Technology accelerated. Public debt expanded. Private markets grew. Global supply chains became increasingly interconnected. The financial system did not stop evolving, it simply evolved in a different direction.
Modern systemic risk no longer lives inside one market. It exists across multiple interconnected systems. Sovereign debt, commercial real estate, global supply chains, digital infrastructure, cybersecurity, energy markets, artificial intelligence, demographic shifts, geopolitical fragmentation. Each appears manageable individually. Collectively, they create extraordinary complexity. Complex systems rarely fail because of one problem. They fail because multiple stresses arrive simultaneously. One disruption weakens another. Confidence changes. Liquidity contracts. Investment slows. Economic momentum fades. The architecture becomes increasingly fragile. This is why predicting the exact trigger becomes almost impossible. The trigger matters less than the condition of the system receiving it. The next recession may not begin inside Wall Street. It may begin inside logistics, energy, technology, government debt, international trade, or confidence itself. Unlike 2008, where banking stood near the center,
future downturns may spread through multiple networks simultaneously. A cyber disruption delays production. Supply shortages increase inflation. Higher inflation keeps interest rates elevated. Higher financing costs reduce investment. Lower investment weakens employment. Employment slows consumption. One layer reinforces another. The recession becomes distributed, less explosive, more interconnected. Not one dramatic collapse, but several systems weakening together. The architecture changes, so does the pattern of failure.
Human beings naturally prepare for familiar dangers. Financial systems rarely reward familiarity. They reward adaptation. Architects understand that every crisis teaches markets something. Participants adjust. Regulations change. Capital moves. Technology evolves, which means opportunities migrate as well. The greatest investors rarely spend their careers predicting the last crisis. They study incentives shaping the next one. Because wealth belongs to those who understand transition, not repetition. The economy resembles a living organism, constantly adapting, constantly reorganizing, constantly shifting pressure from one area to another. Every solution creates new incentives. Every incentive creates new architectures. Every architecture eventually develops new weaknesses.
The lesson is not to forget 2008. It is to understand why it cannot be copied exactly. History provides patterns, not templates. Most people study crises. The architect studies adaptation. Most people ask, what caused the last recession? The architect asks, what incentives exist today that did not exist then? That single question transforms how the future is analyzed, because every generation inherits a different financial architecture. Different technologies, different debt structures, different geopolitical realities, different vulnerabilities. The next recession will almost certainly surprise the majority, not because the warning signs were invisible, but because everyone was looking backward instead of forward. Most people prepare for memories. The architect prepares for systems, because wealth is not built by expecting history to repeat itself. It is built by recognizing how history continuously rewrites its own architecture. The future belongs to those who study incentives before they become headlines, those who see connections before they become crises, those who understand that every economic system contains the seeds of its own transformation. This is Nexera, decoding systems, architecting wealth.